Still paying full taxes on your short-term rental income? What if you could reclassify that income and offset it legally? Welcome to the short-term rental tax loophole that's saving STR hosts thousands of dollars. Hey there, I'm Dustin with AirDNA. If you're a property owner with an Airbnb or a vacation rental, there's a lesser known tax loophole that could dramatically reduce your tax burden, even if you're not a professional real estate investor. This isn't shady accounting, it's legit, IRS-approved strategy. Today, I'll show you how it works, who qualifies, and how you could keep more of what you earn. Normally, rental income is considered passive, which limits your ability to offset it with expenses or other income. But with this loophole, STR income can be treated as active income if you meet certain criteria. This means you can offset it with mortgage interest, repairs, management fees, as well as utilities, furnishings, and even depreciation. To qualify, you need to meet one of 6 IRS exclusions, plus pass what's called the material participation test. So, how do you know if you qualify for this tax loophole? Here's a quick fire breakdown of the most common paths to eligibility. If one of these fits your STR setup, you could be looking at a major tax advantage. Number 1, short stays. I'm talking under 7 days. This is the big one. Your average guest stay needs to be less than 7 days. This is the most common way hosts qualify. If you're running your STR like a hotel with frequent turnover and no long-term leases, you're probably already on the right track. Number 2, short stays and services. Now let's say your guests typically stay under 30 days. But you also offer additional services like meals, daily cleaning, or even concierge-style help. That combination can still qualify you for this loophole. Think of it like this. If you feel more like a boutique hotel than a basic Airbnb, you're in the zone. Number 3, luxury experience. Let's take it up a notch. Do you offer a high-end curated experience? We're talking private chefs, guided tours, maybe even spa treatments. If your STR feels like a full-blown luxury getaway, that level of service moves you into active business territory. And that's a good thing, tax-wise. Number 4, incidental use. This one's for STRs tied to another business. Let's say you run a winery, and you occasionally rent out a guest house on the property. Because your main business is wine tasting and tours, not hosting, the rental income is considered incidental, and that could qualify you for the loophole too. Number 5, open use model. Here's a curveball. If your property is available for non-exclusive use during defined business hours, it might qualify. For example, maybe your STR includes a gathering space you rent out for meetings or events, while still hosting overnight guests elsewhere on the property. Because it's not exclusively used by one party, it opens the door to qualification. Number 6, business use. Lastly, if your STR is owned and operated through an S corporation or partnership, and it's used in the course of business, you might already be in the clear. Bottom line, there isn't just one way to qualify. If you're running your rental like a real business, offering services, or tying it into a broader operation, you might be eligible to use this tax strategy to your advantage. Okay, so you've nailed the short stays. Maybe you're offering a few services. You're almost there. But now comes the final hurdle, material participation. This is the IRS's way of asking, are you actually doing the work? There are 7 ways to prove that you are. And don't worry, you only need one to qualify. Let's break them down. Number 1, the 500-hour rule. If you spend more than 500 hours a year actively working on your STR, that's enough. Guest communication, cleanings, pricing updates, it all counts. Number 2, substantially all participation. If you're doing almost all the work and barely anyone else is involved, that qualifies too. This one's for the solo grinders out there. Number 3, the 100-hour rule. Even if you're not hitting 500 hours, you could still qualify if you work 100 plus hours and more than anyone else involved. So, if you do 110 hours and your cleaner does 80, you're good. Number 4, significant participation activities. This one's for the multi-hustlers. If you're involved in multiple businesses, including your STR, and spend over 500 hours across all of them, you could qualify. Think STR and real estate agent, or STR host and contractor. Number 5, previous participation. Have you materially participated in your STR 5 out of the last 10 years? Then you're already in. Number 6, personal service activity. This one's niche, but powerful. If you've provided professional services like accounting, legal work, construction, etc., and you have connected your rental for 3 of the past tax years to this work, you may qualify. So if you're a CPA and running your STR rental, this one could be yours. Number 7, facts and circumstances. If the IRS looks at the full picture, your time, task, and consistency, and sees that you're clearly running the show day to day, that could qualify you too. It's a bit more subjective, but still valid. So yeah, lots of paths to check this final box. And once you do, you're officially in the zone to use this tax loophole legally. Let's say Sarah owns a vacation rental in Fredericksburg, Texas. She meets the 100-hour rule, self-manages the property, and offers guests local gift baskets and daily check-ins. She earns $85,000 a year in STR income and has $35,000 in deductible expenses. She also qualifies for $20,000 in depreciation. That's $55,000 of income she doesn't have to pay taxes on. Sarah could save thousands just by using the STR loophole correctly. Here's where people get tripped up. Not tracking hours or services provided. Assuming property managers count toward material participation. Failing to document everything. If you want to optimize your tax position, review your property's average guest stay. Track your participation hours. Explore cost segregation with a pro. And of course, use AirDNA tools to benchmark revenue and property performance. Plan now, because the sooner you qualify, the sooner you start saving. Smart STR investors don't just earn more, they keep more. The short-term rental tax loophole is 100% real, 100% legal, and if used wisely, could change the game for your rental business. Drop a comment below about how this video helped you, and don't forget to subscribe. Happy tax savings.